So welcome to this video, and this is going to be number 3 of the Karen the Supertrader series. Had a couple emails about legging into the short strangle, which Karen mentioned that they did. So we're going to look at what possibly could have happened by legging into that strangle. So first, let's draw a couple pictures, and we have to create some rules. Again, we don't know their exact rule set, but let's just say that they were waiting to enter into a trade when the market went down, let's say maybe 5%, something like that. So we have a 5% drop in the SPX, and then we'll use that as a trigger to enter into the naked put. So we start the trade and initiate naked puts after a 5% drop. And then I guess the plan would be when the market moves back up, then they would attempt to lock in some of the profits from the naked puts by then selling the calls. So let's just say there's some rule where it goes back up like this. And then they sell the calls and try to lock in some of the profits and start the trade off with accelerated returns. So let's first take a look at the pros and cons of this. So let's say, again, market drops 5%, you sell some puts. Again, somewhere around 60 days out. And then I guess they possibly could have been waiting for the market to rebound, and then whenever that happened, they would sell the calls. Okay, so that would, ideally, if it worked out, would lock in some profits from the beginning. But now, there's always a possibility that the market could go down 5%, and then you sell the puts, and then the market continues down. Okay, so you have your risk profile that would look something like that. And then if the market, then your delta would be positive here. And then if the market continued down, you're going to start off with a big loss on the trade. And then if you put the calls on after, you're locking in a loss. Or if you just hold your position and never put on the calls, then you just keep taking on more and more risk as the market goes down. And in fact, you may never get to put on the calls if the market doesn't move back to the beginning point right here in time. And so in that case, you just have some naked puts on. Or the thing could be reversed, where let's say the market moves up this way, you put on the calls, then the market continues to go up, and then your short calls get hammered, and then you never put on the puts. So if you think about it, legging into the trade, it's going to accelerate your losses at times, and then it can accelerate your returns at times. So it could be approximately, it could be a wash. You could have the same outcome as putting on the strangle all at once. When you put the strangle on at once, then at least your short calls and short puts are hedging each other. If you leg in, you're actually taking on more risk. And when it goes against you, you lose faster. When it goes your way, you make money faster. But let's just build one and kind of walk through a volatile time and test out the concept. So we're going to do a quick study on this week because, again, in the interview, Karen mentioned her buying power disappeared instantly during this week. So let's see what possibly could have happened. Let's say she didn't have on any trades, and then they were waiting for a 5% pullback. So if you do the calculation The price here is about 13.44. Then 5% down would be about 12.76. So right on this day, it's hitting the 5% down. So towards the end of this particular day, 8-1, they may have entered into the put side. Okay, so we're going to do that. We're going to go to 8-1, and we're going to enter into naked puts at the 5 delta. So now we're looking at the possible risk profile if you just put on some naked puts on that particular day after 5% pullback in the SPX, and then you can see that the margin here would be about 100,000 because I'm measuring 10% down using the standard TIMS calculation using sticky strike where the volatility remains the same per strike. Okay, so the risk, the 10% risk in the risk array at that point is 100,000. So if you want to think in terms of Karen's fund, we'll bump that up to 100 million. And we'll imagine she's using 50%. So let's say they have 200 million of their net account value, and then we'll use 50% of the margin, which is what they stated they were doing. So they're using about 100 million and legging in with the puts. Again, we're just guessing. I have no idea what they really did. Just trying to figure this out, what possibly could have happened. So we sold some puts over here at the 5 delta. And now we'll advance the calendar, and then we'll, again, look for that entry of the calls. So we need a 5% move up. So essentially, if the current price is 12.86, then we need the price to get up to about 13.50. Let's jump over to the price chart though, and we can just see what happens. So 13.50. So if you look at the chart though, it never gets back to the 13.50. So this is the problem when you're legging in. Okay, so we'll just see what would happen then. So the first day after the 5% retracement, well, it moves down almost, well, it moves down about 2.5%. All right, so immediately the trade is currently down 11,000 or 11 million. So the new margin is about 154 million when it started at 100 million. So in one day, the account is almost in a margin call, but not quite. Let's see what happens the next day. Next day, market bounces up a little. Trade is currently just down about 6 million, and the margin is, once again, is still higher than the, it's at 132 million, so it's still increased 30 million. Next day, now the trade's down 73 million, and the new margin would be almost 300 million. So let's pause there. $73 million drawdown with a new margin of this. So let's look at this real fast and see what's going on. Okay, so we started with 200 million. The trade is down, I already forget, bad memory, but it was down like 70 million. So we have about 130 million left in that account. Your margin started at 100 million, and you were using, or they were using or we were using 50% of the buying power. Now the new margin's 292 million. It's almost tripled. But you can see that the net liquidation value is only 130, so you have just a humongous margin call on 8.4. So this gives you a margin call of 162 million. In just a couple of days there, actually just overnight. Okay. Now, this really exemplifies exactly what can happen when you leg in. So actually it could be much worse than if you just start with the strangle, as you can see. Because if you look at the other videos where we're just doing a straight strangle, the margins don't change quite as fast because the calls and the puts are hedging each other. But here you just have the naked puts without any calls, and it's pretty amazing that you can get a $162 million margin call overnight doing that. So assuming they didn't have that money, so the new account values of 130, and then if they want to maintain the 50%, all they can invest is 65 million. But their current trade is 292 million. So if you do the math there, 292 divided by 65, they can only have a quarter of that. So basically they have to reduce the size of this trade at that point down to just about 25% of what it was, and I will do that. Okay, so now I size the trade down to about a quarter of the original size, and you can see with the adjustment to meet that margin requirement, now the bar is at negative 48 million. So the best they can do, so the trade's down 73 million, but there's hope they can recover part of it, and then the best they could do is 48 or almost 49 million dollar loss. And so that just shows you how in one single day that type of trading can put you in a hole that you'll most likely never recover from. So that could be possibly what happened. And then after they were down about 50 million, then, you know, again, there could be some wins, some losses, but just don't have the capital left to recover from that. And then we could continue. I mean, now that we met the margin call, whatever, you can go a little more. So now it's a little more down there. Your margin over here is 130,000, so you're about maxed out already. And then another big day down, and you're just in big trouble. Now the account's pretty much wiped out because now you're down 120 million. Well, if you started with 200, I guess you still have 80 million, but now you have another margin call, so now 10% down. Your margin requirement is 200,000, but the account only has 120,000 left. So now you have to size down again, and then you go through the whole process. And then after that, the best you can do is probably lose 100 million. So anyway, that's what can happen if you leg into that strategy, and then the market doesn't rebound, and then you don't have the opportunity to put the calls on. The same thing can happen on the call side if you start the call side first, and then your underlying product continues to drift up, and then you don't have the opportunity to put on the puts. Same thing can happen. So if you're considering this, then again, you want to always stress test. If you were working with different rules, let's say 5% here, 10, 15. I mean, looks like about a 15% drop. So the thing is, if you're waiting for a 15% drop before you put on the puts, well, then you may wait an entire year to do a trade. And so then you're actually missing all of these opportunities where the market's kind of going sideways, and that could possibly be more appropriate for the short strangle. So so there you have it. So again, do all your back testing if you're trying to leg into this strategy or another one. Again, you really have to stress test the margins and the profits and losses in order to be safe. So make sure you do all the testing before you use real money. So that's the third presentation on what possibly could have happened to Karen's fund. Thank you very much, and hope you learned a couple things in that class.